Hello, everybody, and welcome to another financial analysis session where this time we're going to be looking at a company called Tern. So this is a company that is it's a venture capitalist company. So here it is. Tern provides venture capital funding to exciting high growth IoT, that's Internet of Things innovators in Europe. They also provide support, helping the creation of a collaborative environment for talented, well-motivated teams. They help business owners to fulfill their potential for fast growth, market leadership, and strong exit multiples. So this is a very proactive venture capitalist company who are identifying really exciting new innovations. They are investing, so they're providing the financial muscle for them. They are also helping to kind of create the leadership team to motivate them and to realize very, very high multiples on exit, effectively on flotation or on sale. So we are analyzing Tern because the request of Gillian. So here you go, Gillian. This analysis is for you. So without further ado, let's jump in and look at the financial statements of Tern. So here are the financial statements of Tern. They are very easy to get. They are available to be downloaded from their website. So let's whiz all the way through the report. And if you want to learn more about the company, you can either visit their website or you can look through this report in your own time. Lots of pictures of all the people who are involved. We'll talk a little bit about them later on. But we are going to go straight to the income statement, the profit and loss account, in order to find out how this company is doing. So profit and loss account, here it is. It's on page 46 of their accounts. And we notice that the top line shows us the sales. So here is our sales. And the sales for these guys is about 2.2 million pounds. So we're in pounds. And most of that is coming from the movement in fair value of the net assets. Okay, so you remember this is an investment fund. They've invested in companies. The value of those companies have gone up by £2 million, and they get a little bit of fee income as well. So this 151,000 of fee income, this is effectively the fees paid by the companies that they've invested in for their help, for their advice, etc., etc. So the substantial amount of this comes from the movement in fair value of the investments. Okay, so and we can find out a little bit more about that on note 11, and it's probably worth, because that's the big number, it's probably worth going to note 11 just to see if it tells us anything more about the business. So here we are on note 11, and we can see the value of the investments. So this is the value of the investments at the beginning of the year, which is the end of last year. So that's a kind of a carry forward, and then they have increased by this amount. So this is additions to the investments, This is the additions. This is new investments made during the year. These are some companies which they've sold, and this is the increase in the value of their existing portfolio. So what we see here is the, and this is reflected in the non-current assets. So we're actually looking at the balance sheet here. So this is effectively the value of the portfolio at the beginning of the year. This is new investments during the year. This is exit from investments during the year. They've sold some investments, and this is the increase in the value of the underlying investments. Now, the first question we have to ask ourselves is, how did they come up with that increase in the value of the investments? So there's a number of ways you can do this. You can mark to market. So if they are traded companies, if they're invested, if you've invested in BP, it's very easy to find out how much your investment in BP is worth. You just look up the BP share price at a particular point in time and multiply by the number of shares that you own. However, I'm reckoning that these guys are not investing in listed companies. They're investing in unlisted companies, so early stage startups and looking to exit. And therefore, this will probably be more likely to be mark to model. And mark to model effectively says that they have come up with a model, a spreadsheet, if you like, of how they're going to value these companies. And they put in their inputs and the model tells them what it's worth. Now, you and I know that we only actually find out what something is worth when we take it to the market, when we actually sell it. So that 2 million of revenue is kind of is their own assessment of the revenue. I'm not necessarily saying that that really is a reflection of the revenue of the company. So it's worth having a look at the accounting note. So the first note of the accounts talks about the accounting policies, and here we see in 1.6 turnover, and turnover talks a little bit about how they recognize recognize their revenue, and talks a little bit about under IFRS, that's the International Financial Reporting Standards number 15, recognizes revenue is recognized at an amount that reflects the consideration to which the company is expected to be entitled. So in effect, what they're saying is that their portfolio has gone up, and they're recognizing as a result of that increase in the portfolio, they are entitled to that particular revenue. However, we know that actually they're not necessarily going to get that revenue until they can actually recognize recognize their investment. So let's return back to the income statement and see what else is going on there. So in the income statement, we see that, so it's 2 million of turnover. The cost of running the business are about 1.3 million. So that'll be the investment directors, the people who are going out there, finding the opportunities, meeting the companies, looking for the opportunities, and then making those investments. And that's really the big number there. So this is a company which is effectively getting a little bit of fee income. It's costing about 1.3 million to run, and they get a little bit of other finance income, etc., etc. So the profit here of 803,000 it's a little bit of a misnomer to me. I think it's a little bit hard to kind of to configure that. And you'll notice there's a loss in the previous year, and really that loss is driven by the fact that the value of their investments did not rise significantly or enough. Okay, so let's go and have a look at their balance sheet and see about how strong the company is. So here's the company itself we're looking at. So the non-current assets are the investments themselves. So there's about 22 million pounds worth of investments. Remember that this is reflecting their current value, not the value at the point of investment. So there is increase in the value, and they've recognized the increase in the value of those investments. As we saw, and they're showing that increase through the income statement. They also have current assets. Here there are current assets, a little bit of trade and other receivables, but mainly lots of cash. So this cash here is cash not only to run their business, but to also make investments, additional investments. So they've got about 2 million pounds sitting on one side, ready to invest should a great opportunity come along. In terms of the liabilities down the bottom, just move this balance sheet down a little bit. Here we go. So the current liabilities, there are no non-current liabilities because they don't have any debt funding the business. So they've just got a little bit of current liabilities, and we can see if we compare the current liabilities to the current assets, this is really not an issue at all. So they've got enough cash to be able to pay their bills should they need to. What is quite interesting is looking at the equity, that's this bit here. And we notice, let's just clear those drawings so we can see it without any unencumbrance. So there's share capital and share premium. This is the total amount of investment the company has raised so far in total, and the retained earnings is actually retained loss of about 4 million pounds. So in effect, this company has, since it started trading, it's raised about 28 million pounds. It's lost 4 million pounds, but it's got 22 million pounds worth of investments and 2 million pounds of cash. Now, I think those retained earnings are pretty historical, so I'm not going to worry too much about these numbers here. You'll see that the profit they made in the year has caused that retained earnings to fall. So let's go and have a look at the cash flow statement and see what's going on there. So the first thing we see in the cash flow statement, here we go. So the cash flow statement, so the first thing we see is that the net cash used in operating activities up here comes from note 20. So in lots of companies, they're going to put this information in the top of the cash flow. Some companies choose to actually put it in the notes to the accounts. These guys have chosen the latter. So we need to go and have a look at note 20 to find out how that 1189 was actually arrived at. So how we reconcile the operating profit with that operating cash income. So let's go and have a look at the note. So here's note 20. So here is the profit. So they're reconciling the profit up here, and they are showing how, while they made a profit, they've made a cash loss. Now, why do they make a cash loss? Well, we can see fairly easily, and it kind of makes sense, because most of the profit that they made is relating to the increase in the value of their investments. So if you think about it, if you've invested in, for example, BP, and the share price of BP goes up, you may be better off, but you don't have any extra cash in your pocket. Okay, so they've had to take that bit out. We also notice that there's this share-based payment charge. So some of the staff are being paid in shares. So this has a positive effect on the cash, because it's in the income statement, it's in the profit and loss account as a cost of running the business, but they're not paying their staff in cash, they're paying them in shares. The effect for you as a shareholder means that you are being diluted in effect. But on the other hand, it's good because it means that the directors are incentivized to make sure the company is very, very profitable and the share price goes up. So not a lot of other movements going on there. So that's why the company is effectively, it's burning about just over £1 million from its operating activity. So let's go back to our cash flow. Now, what is quite interesting about this company is in their cash flow, so this number here, the 3 million, this is the net cash used in operating activities. Traditionally, that is the cash, that's the sort of the cash equivalent of the operating profit. However, what we notice here is that there's a big gap in here, that they don't have anything which shows the cash used in investing activities. And actually, we suddenly then realize that the reason they don't is because all of their purchasing of investments is going up here. So actually, I think we should probably take that out and park that as a separate amount. So in effect, this is their cash loss. That's the kind of the loss they're making from the trading, okay, and that's very similar to their overheads. And what we actually find is that this is their staff costs, okay. So this is their staff costs. They're not getting very much fee income, and so they are operating at a cash loss. However, they are making investments of about 2 million. And this is all being funded through the issue of shares. So here are the issues of 4.5 million in this year and 3.25 million in the previous year. So these guys are effectively, it costs £1 million a year to run this business. And they are funding that by raising shares, and some of those shares are being invested into new companies, and some of them are paying the salaries of the investment staff. So if we go back to the income statement, for example, and we see in the income statement, we'll just whiz back to our income statement, here it is. So the administrative costs here. So you remember the administrative costs are about 1.3 million. And the main element of those costs is the staff. So if we go and have a look at the staff and how much the staff is actually costing the company. So here's note 5, which shows the staff cost. You'll notice that the staff costs are about 940,000. So basically just shy of £1 million. So of 1.3 million, 1 million is pretty much the staff costs. The staff costs are all directors. They've got one admin staff, a PA, for example, and that's effectively what you're paying for. So really, this company, the business model of this company is that they're issuing shares, they're using those shares in order to pay the staff, and those staff, effectively that's what you're buying is their investment expertise, and you're buying the expertise of the investment directors who can go out and who can find companies which will grow in value and make the company a lot of money. At the moment, it's costing the company about £1 million a year to run, and so when they do a share issue, in effect, £1 million goes into the directors' pockets to pay for their salaries, and the rest is then invested. So, for example, 2 million, and they're also showing that their investments are rising by £2 million in the last year. However, we have to question whether that is an actual rise in value, because that is mark to model. It's not an actual rise, at least I don't think it is. And so it's the proof is in the pudding. So it's only worth that when they actually come to exit. So looks like there's it's an interesting business model. It's a kind of it's a pretty standard investment fund, a private equity investment fund. Let's go and have a look at the share price and see how it's been performing. So this is the maximum share price. So these guys took an absolute pasting around 2007-8. So this is, remember, the global financial crisis. So the share price was, clearly very, very high and has dropped very significantly. And then it just flatlined and has gone nowhere. So I think on this scale, it's not really telling us anything. And also, it kind of gives me a feel that the losses, the historical losses, I think are reflected in the that's where the historical losses come from. Okay, although I haven't actually investigated that. So here we're looking at 5 years, and we can see that the share price is kind of bouncing around, and they're trading on a PE ratio of 86, 87 times. Now remember, that's 87 times their profit, and the most of that profit is actually the increase in the value of the underlying portfolio. So this kind of, this didn't really sort of stack up to me. I'm trying to work out why this is. And then we look at the market cap. Now the market cap, traditionally we compare that market cap, the value of the company, with the underlying net asset value, and the difference between the underlying net asset value and the value of the company is the goodwill. And we look at someone like Coca-Cola, for example, they have a lot of goodwill, and we'd expect that because that goodwill is in the brand. So Coca-Cola, it has a lot of assets, but the real strength of Coca-Cola is its earning potential. However, for this company, it doesn't really stack up because it's effectively an investment fund. It's a private equity investment fund, and they bring additional services as well as just their actual fund. But it is an investment fund, and the net asset value of this company is about 24 million. That's the underlying investments. Don't forget which have gone up in value. So this is the market value of the underlying investments is 24 million, and the market value of this company that's invested in them is about 80 million. Okay, now if this was an investment trust, then we would be talking about it trading on a 230% premium, which is kind of crazy. So I would struggle to understand why anyone would think it was a good idea to buy a company for 80 million, or to invest in a company that's worth 80 million. That's the price you're paying per share, when the underlying assets you'll get, you're only getting 24 million of underlying assets. In fact, that's 22 million of investments and 2 million of cash. So take out the cash and you're just buying that 22 million. So effectively you're paying 78 million in order to buy underlying assets of 22 million. Now, maybe the portfolio is, absolutely poised to go ballistic. Maybe these guys have got the golden touch. They've found the opportunity, but this is a really strong play on the investment managers. And I don't know them that well. I haven't heard of them. I don't know about their track records. So personally, I'm not sure that this is the investment that I want to be making. So there we have it. There's Tern looking at their financial accounts, and remember, this is known as a fundamental analysis. So we're just looking at the pure numbers. So there's nothing in my analysis which is looking at the company and the companies that they're invested in, and the potential of the companies that they're invested in. And you may be sitting there thinking, Ted, I know something different. I know that they've got exposure to certain areas where the blue touch paper is going to be lit and this thing is going to go ballistic, and this is an absolute bargain price. And if so, I'd love you to be able to share your comments, your ideas, your observations, your knowledge with us in the comment section. But otherwise, thank you very much for listening and watching this video. Please don't forget to like, share and subscribe to the channel, and I will see you in the next video. Thanks a lot.